Welcome to Breaking News to Trading Moves. We're jumping right in today with a development in the digital infrastructure world. Bitfarms, that's BITF, announced it's moving away from its core business.
Away from Bitcoin mining specifically.
Completely. The plan is to wind down all mining by 2027 and convert their facilities into AI and high-performance computing data centers.
It's an ambitious strategy, to say the least.
It is, and what really stood out was the market's response. The stock slumped right after the announcement. And that was despite a positive quarterly update. It seems like investors felt a lot of immediate uncertainty about this new direction.
Well, yeah. I mean, this move by Bitfarms, it really forces everyone to reevaluate the whole landscape.
How so?
We're basically seeing a sorting mechanism play out in real time. Companies are either going to gain favor or lose it based on, how close their assets are to supporting AI.
Versus how dependent they are on that traditional crypto mining model.
Exactly. So what we should do is map out which specific companies are getting sorted into which bucket right now.
That sets the stage perfectly. So let's start with the clearest beneficiaries. The companies that profit directly when Bitfarms, or anyone like them, makes this kind of switch.
You mean the hardware providers?
Right. The ones supplying the gear for AI data centers.
Precisely. This pivot isn't just about swapping one machine for another. It's a total upgrade of capability.
Okay.
So when miners repurpose these enormous, power-hungry sites for AI and GPU hosting, they create instant demand for high-end accelerators and really dense server builds.
An immediate revenue path for the hardware giants.
Exactly. And the main winners here are, well, the usual suspects who kind of control that AI hardware supply chain.
I think I know who you're going to say.
Nvidia, of course. That's NVDA.
And Supermicro.
And Supermicrocomputer, SMCI. These companies sit right in the path of every dollar Bitfarms is planning to spend.
So every new data hall they provision with GPUs and racks.
Translates directly into guaranteed sales for them.
Okay, I get the hardware angle. But let's talk about the technical side for a minute. Are these former mining sites, which were built for cooling Bitcoin ASICs, are they actually ready for AI workloads?
That's a really important point. And no, they're not plug and play. Bitcoin ASICs, they draw a lot of power, but they're relatively easy to cool.
Okay.
AI chips, like H100s or the newer ones, they need exponentially denser power per rack and create so much more concentrated heat.
So it's a different problem entirely.
It is. But the huge advantage these mining sites offer is their pre-existing connection to massive amounts of power, often cheap, renewable power.
So the high voltage infrastructure is already there?
It's already in place. So while the cooling needs a complete and very costly overhaul, the hardest part of building a new data center is already solved.
Securing and delivering all that power.
That's the one. That underlying power asset makes the real estate itself very valuable.
Right. Which brings us to the physical assets. The land, the power connections. How do the established data center REITs and colocation providers benefit here?
Well, the Bitfarms move just underscores that power-rich land is the true commodity in this whole equation.
So landlords are in a good position.
Landlords like Equinix EQIX and Digital Realty DLR, they stand to gain a lot of momentum from this.
And why is that?
Because crypto mining often relied on short-term, sort of opportunistic power contracts. The revenue was volatile.
Right.
But the customers for AI compute hyperscalers, large enterprises, they demand stability. They want long-term leases.
5-7 years, something like that?
At least. So if more miners pivot or partner up with these established landlords, the REITs get stronger pricing power. They're securing these long-term, high-value AI and cloud leases.
And the market loves that kind of contractual stability.
Loves it. It's viewed as so much more valuable than the unpredictable nature of mining leases.
That makes sense. Okay, let's go back to the crypto sector itself. If some miners are leaving the game, who benefits from that? Who wins among those who stay dedicated to Bitcoin?
The beneficiaries are the miners who have already achieved, operational excellence and really low production costs.
The ones who are committed to staying in it.
For sure. When these marginal players start to wind down, it just alleviates some of the competitive pressure on the survivors.
And which companies are we talking about here?
We're looking mainly at Marathon Digital, MARA, and Riot Platforms, RIOT.
So what are the mechanics? How does it help them?
It comes down to the hash rate. Bitcoin mining difficulty automatically adjusts based on the total hash rate pointed at the network.
Okay.
So when smaller, higher-cost players exit or redirect their capital, the overall growth of that network hash rate cools off.
Meaning the difficulty doesn't ramp up as fast.
Exactly. It makes it a little easier for efficient survivors like Marathon and Riot to capture those block rewards without constantly having to upgrade their machines just to keep up.
They gain efficiency just because the race slowed down a bit.
That's it.
Okay, so the efficient stay, the less efficient redirect. Now let's go to the flip side. Who faces the immediate pressure here? And I guess that starts with the pivoting companies themselves.
It does. The big challenge for pivoting miners, like Bitfarms, BITF,
Yeah.
and some peers who've signaled similar AI ambitions, like Iris Energy, IREN,
Yeah.
is just immense execution risk.
What does that look like?
They're essentially trying to become data center providers overnight.
Yeah.
And that requires a completely different skill set.
It's not just managing ASIC machines anymore.
Not at all. It's attracting specialized AI customers, managing these complex, multi-million-dollar build-outs with specialized cooling.
And handling huge capital expenditures.
All of that.
Huh.
And they have to do it while their known crypto cash flows are shrinking.
So the market sees that as an in-between story.
A very uncertain one. So it applies a heavy valuation discount until you see clear utilization rates and sign contracts with major cloud providers. The massive challenge.
So if the bigger players are struggling with that transition, what does this whole environment mean for the smaller, pure-play Bitcoin miners? The ones who have neither marathon scale nor the infrastructure to convert to AI.
Well, this pivot is a huge warning sign for them. It just highlights how tight the pure-play mining economics have become.
Especially after the latest halving event.
The halving plus rising power costs globally. It's a squeeze.
And are there specific companies that look vulnerable?
I think so. You could look at names like Hut 8, that's H-U-T, and Stronghold Digital Mining, SDIG.
What makes them vulnerable?
They just have less operating scale and often don't have the same kind of power infrastructure that a Bitfarms might be able to leverage for an AI conversion.
So they're stuck.
They're stuck between the diminishing returns of pure mining and the huge capital barrier to get into AI hosting. If investors keep moving capital towards AI-linked plays, these stocks face pressure on both their margins and their valuations.
Got it. Okay, one last area. How does all this uncertainty impact the investment vehicles tied to the whole sector? I'm thinking about the crypto miner ETFs.
Well, anytime a major holding has a double-digit drop, like Bitfarms did,
yeah.
and you couple that with this fundamental uncertainty about its entire business model, it's going to put downward pressure on the whole basket.
And that directly impacts specific ETFs.
For sure. We're talking about funds like the Global X Blockchain ETF BKCH and the Valkyrie Bitcoin Miners ETF, WGMI.
And what's the effect?
As the companies inside these funds are juggling between two completely different strategies, mining versus AI, the overall volatility of the fund just goes up.
And that instability can scare investors away.
It often prompts outflows, especially when it's linked to bad news. It just complicates the mission of these funds, which were originally set up to track pure crypto performance.
This really lays out a clear map of how capital is reallocating. We're seeing a definite divergence in valuations, favoring companies closer to the AI boom over those still dependent on crypto mining.
I think the real focus going forward is going to be on property valuation.
What do you mean?
Well, we have to ask whether the value of this former crypto mining real estate will now be judged entirely on its potential as a high-performance computing center.
So measured by power density and cooling capability.
Right. Or will the underlying energy price and source continue to be the main driver of its worth? That balance is going to dictate which of these companies ultimately succeed in making the AI transition.
A lot of complex decisions converging all at once. Thanks for walking us through all of that. This is not financial advice or a recommendation to buy or sell. This is purely the opinion of the author.